A war thousands of miles away could be silently draining your bank account right now. And once you see this chain reaction, you'll never look at global news the same way again.
Welcome to The Explainer. Today, we're going to break down how a crisis halfway across the world can send ripples through the markets and right into your portfolio. And more importantly, we're going to build an actual playbook to help you navigate these storms with some real confidence. It's a question we all kind of ask ourselves, right? You see a headline about some conflict thousands of miles away, and it just feels so disconnected from your daily life. But we're about to connect those dots and show you exactly how a single event over there can have a direct impact on your wallet, right here. So, it all starts in this one spot, a tiny, but believe me, incredibly strategic 33-kilometer stretch of water called the Strait of Hormuz. When this shipping lane gets shut down, it doesn't just mess with global trade. It kicks off a financial chain reaction, a domino effect that travels thousands of miles and lands right in your bank account.
And the very first domino to get knocked over? Crude oil. The impact here is immediate, and it is powerful. See, this strait is like a major artery for global oil, and when it gets clogged, the supply shock sends prices through the roof pretty much overnight.
To give you some perspective, let's just look at the numbers. Just a little while ago, on February 27th, the market was calm, it was stable. Crude oil was trading at about $72 a barrel. Nice and predictable. And then, bam, the price just shoots up to $105. Now, for a country like India, which imports a staggering 85% of its oil, this isn't just some number on a screen. It's a massive economic shockwave that hits us, well, almost instantly.
So, because we depend so heavily on foreign oil, all that pressure has to go somewhere, and it lands squarely on our currency. I mean, think about it. If we have to spend way more dollars to buy the same barrel of oil, the value of our rupee starts to slide. The result? A much, much weaker rupee. And that has huge implications for the stock market, because when the currency is falling, foreign investors tend to get nervous and start pulling their money out, which just adds even more downward pressure. And this is how that whole chain reaction hits you personally. Higher oil prices mean it costs more to transport goods and make things, and that fuels inflation. So to fight inflation, what does the RBI do? It might raise interest rates, and all of a sudden, your home loan, your car loan, your personal loan, those payments could all start to climb. That is a direct line from a distant conflict straight to your monthly budget. But, in a choppy market like this, the damage isn't spread evenly. Not every sector gets hit in the same way. In fact, for every part of the market that's feeling the pain, there's usually another one that's actually in a position to do pretty well. You get this really clear divide that emerges. On one side, you've got sectors that can actually thrive because of higher prices or a weaker currency. And on the other side, you've got the ones that just get squeezed by rising costs and people spending less. Let's break them down. Okay, first, the winners. Oil and gas companies, no surprise there. Their profits go up when crude prices go up. The pharma sector, well, they export a ton and get paid in dollars, so a weak rupee is fantastic news for them. And during times of geopolitical tension, defense stocks often do well because, well, governments start spending more on security. On the flip side, some sectors are facing some serious headwinds. Aviation gets hammered. Fuel is their single biggest cost. The paint industry struggles because a lot of its raw materials actually come from crude oil. Banks start to worry about bad loans, what they call NPAs, because it's getting harder for people to pay their EMIs. And real estate, it gets a double whammy. Materials cost more, and demand drops because expensive loans scare away buyers. But in the middle of all this, there's one sector that's a real head-scratcher: information technology. Now, normally, a weak rupee is great for IT companies, so why are they struggling right now? Well, the reason is that all these other fears, especially around AI, have been pushing the whole sector down, basically wiping out that currency advantage. But this has created what some analysts think is a really interesting opportunity. Their logic is pretty simple. India's IT sector was never about inventing the next big thing. It's always been about being the essential support crew that helps run it. And in the long run, you always need the support crew. So all of this, the dominoes, the winners, the losers, it all leads us to the one single, most important question that's probably on your mind right now as an investor. When you're just getting bombarded with bad news and you see your portfolio bleeding red, your gut instinct, your lizard brain is screaming, sell! Sell everything and run for the hills. But is that actually the smart thing to do? History shows us a really clear pattern here. Markets tend to freak out when there's a shock.
they fall hard, but eventually they recover. So for a long-term investor, these downturns, they're not just something you have to survive. They're actually an opportunity. Every single SIP payment you make is now buying more units for the exact same amount of money. You're basically buying low, setting yourself up for better returns when the market turns around.
Okay, so instead of reacting with fear, let's be proactive. It's time to build a clear, simple plan, a playbook, if you will, that helps you get through this volatility not with panic, but with actual confidence.
The single most important rule in this entire playbook is this: never, ever, ever put 100% of your money into stocks. A balanced asset allocation is your portfolio's best defense, its shield. By mixing your stocks with the stability of debt or fixed income and the safety net of gold, you create a portfolio that's built to be resilient.
So how do you actually put that idea into practice? Well, building a resilient portfolio isn't some complex secret. It really just comes down to following 3 simple, logical steps.
It all starts with being clear. First, know why you're investing. Is it for retirement, your kids' education, a down payment on a house? Second, based on that goal, figure out your asset mix. How much in stocks, how much in debt, how much in gold. And finally, you have to diversify within each of those buckets.
This layered approach to diversification, it's like your superpower. Within your stocks, don't just own Indian companies. Get some international exposure, maybe with US stocks. For your debt portion, use a mix of stable things like fixed deposits or debt funds. And that small slice of gold, that's your insurance policy for when things get really crazy. This way, if one part of your portfolio is having a bad month, the other parts are there to hold things steady.
Here's the key thing to remember. A well-built portfolio doesn't make you immune to market swings. That's impossible. What it does do is give you the structural strength and, maybe more importantly, the mental confidence to stick with your plan. It helps you avoid making those emotional, fear-driven decisions that can absolutely wreck your long-term wealth. Look, at the end of the day, history has shown us time and time again that market downturns, no matter how scary they feel in the moment, are temporary. But the decisions we make during those downturns, those can have permanent consequences. So the real question isn't about the market, it's about you. Is your portfolio actually built to last? By focusing on these principles, you can turn a time of anxiety into a genuine opportunity to build real, long-term wealth.
If you want more breakdowns like this, real strategies, no hype, hit subscribe right now. This is the exact playbook professional investors use, but most people never see.